back to my Word document, those are the areas that I really need to pay attention to in making sure I understand that when it comes time to the quiz.
Yep, absolutely. So, okay, I gave you a little preview on that one. I think that's, let me just check one more thing. I don't mind spending just a tad more time if you're willing to stay here with me for a second. Let's see. Somehow I lost my quiz access. Is this right? Chapter 2? No, it's chapter 11.
No.
Chapter 11, quiz access. Policy, preview. Yeah, so I moved this outside of here. That's why, that's what happened. Okay, I'll move it again. Let me just, so I know I already give, for those that take screenshots of the video, they'll have picked up at least 2 others, but no par. Okay, remember, land is no different. Any asset is no different than one or the other. It's just all gets coded to a different account instead of cash.
And expenses, they're always over on the equity side. If it says expense or not, well, like there was all kinds of expenses in that chapter 2. And they throw me because sometimes I always thought they were somewhere liabilities, but there's like salary and wages and all that would go and reduce equity, right?
Yes.
On the right.
Expenses reduce equity. That's correct.
Are there any expenses that just are regular like liability that you'd pay, but like utilities, all that kind of stuff is an expense that stays on the right?
So normally an expense, most businesses will, here's the journal entry, and this is the best way I can explain it. Sorry for always doing this, but it's the only way.
I just get confused on the expenses where they technically go. Because it seems like some of them I used to do and it was different, but I don't remember.
Yeah, no problem. So a utility expense, let's say you get the bill, right? You haven't paid it yet. And let's say it's $100. So first of all, the utility expense is an expense on the income statement, which flows into the retained earnings, and therefore it's a debit. It decreases equity, right?
Okay.
So that's where you're going to get this part of the entry. But usually they'll go to accounts payable, right? First, it won't come out of cash initially. It'll go as an accounts payable, and then it'll get paid out later. So what ends up happening, excuse me, is that the opposite side of this transaction is a $100 credit to accounts payable, which makes it a liability, right? And then when I go to pay it, it usually is accounts payable as the debit, and then cash as the credit. Right?
Yeah.
So
I think that's where I get tripped up. Yeah.
Your first impact is on the income statement, which effectively flows into, I'll just put like this, into equity, okay, on the balance sheet. And then this is the balance sheet impact. This is a balance sheet impact, and this is a balance sheet impact. And this is balance sheet asset, and this is balance sheet liability, and this is balance sheet liability. On the revenue side, it's a little bit differently. So let me just, let's keep this. I earned some revenue. So, and it's not going to go to cash immediately. Usually it goes to accounts receivable. And let's say it's $1,000. Okay. As my asset. And I have service revenue. And it's going to go over here on the credit side. Now, this is a balance sheet asset account, and this is a income statement first, which effectively goes to equity. Okay. And then when I actually get paid for it, when the client pays me, then it's going to be cash for 1,000 and accounts receivable for 1,000 as a credit. So this is a balance sheet asset account, and this is a balance sheet asset account.
Asset or, oh, yes, okay, same side, okay.
Yeah, because it's just moving it from cash I'm going to receive in the future to cash I have received, right?
Mhm.
So that's how your revenues typically run, and that's how your expenses typically run in a business. Your investments are going to be similar, but like we've already gone over. So like if an owner invests money into the business, you're going to get cash, and let's say it's $10,000. Oops. And we're going to give them some common stock of whatever sort, right? And let's say it's common stock, and in this example of a dollar par value, right? So let's say we gave them $1,000 of a common, 1,000 shares of common stock, $1 times 1,000 shares, and then we'd have paid in capital common stock, and this would be the difference between the two, right? So this is a balance sheet asset account. This is a balance sheet equity, balance equity, right? And that's how you get those things to balance out.
Mhm.
Okay.
Thank you.
Yeah, absolutely. I was gonna go over this a little bit, but I think it's pretty, it's just